Good morning, everybody. Thank you so much for joining this YCharts webinar, Powerhouse Your Practice. I'm Blair duQuesnay. I'm the lead investment advisor at Ritholtz Wealth Management, and I am joined today by two esteemed panelists, Stephanie Link from Hightower Advisors and Liz Young at SoFi. I'm so excited to get into this conversation with these two ladies. I'm going to ask them some questions about what's going on in the market. So if we can flip to the next slide. Thank you all for joining us today, and thank you for YCharts for putting this together. Just a reminder, this is all for informational purposes only. We're just going to have a discussion about the markets. So let's go through the agenda. We're going to start with talking about market trends and opportunities, moving on to navigating volatility, talk a little bit about what we think might be happening next, and then hopefully have some time for Q&A. We've got about 30 minutes this morning, so we'll see if we get a chance to get to some questions at the end. So let's get right into it. What's going on year-to-date market trends? So here we have the year-to-date major index returns around the world. No surprise, the NASDAQ is flying high again. Maybe it is a surprise, but we all know that the NASDAQ has been flying high above some of those other indexes, while small cap and emerging markets lagging behind. So ladies, any comments about where we've been year to date with market index returns?
Well, I guess I'll start. I would just say, if stepping back for just a half a minute, the economy at large is actually doing a lot better than what most people had expected. At the beginning of this year, people thought the first quarter GDP was going to be the peak, and it came in at 2%. And what we've done since the first quarter is actually accelerate to 2.4% in the second quarter, and the Atlanta Fed GDP now, which always starts out high, is at about 5.8%. Yes, 5.8%. That is way faster and higher than expected. And a lot of that is driven by the resiliency in the consumer. And we pay attention to the consumer because 75% of GDP is the consumer. And that has been propped up by better jobs and higher wages and a recovery in housing, believe it or not, at least in new home sales. Manufacturing is still in the doldrums, but we are starting to see some recovery in certain end markets like onshoring and aviation. But just setting that back as the kind of the backdrop, that has led to a little bit better in terms of earnings, and also a little bit more of a broadening out in the market. And I would love to get Liz's take on that as well. She thinks that actually is going to continue. Maybe not today, maybe not yesterday, because obviously we had the strong results from NVIDIA, and that's propping up the technology sector. But I am encouraged that it's not just the Magnificent Seven that are leading us. They did take a breather in August, and that's, again, when we started to see this broadening out. And to me, that's healthy. That's healthier than just having the markets dominate. And I mean, you look at these charts, and it doesn't. It looks like, the technology is continuing to dominate, but underneath the surface, there's a lot more going on, in my mind.
Yeah. So just to kind of start there, I'll start where Steph left off. Tech does appear like it's still dominating, but if you look at under the surface of the NASDAQ, actually breadth has deteriorated in that index, and then you've seen breadth get stronger in something like the S&P 500 and even some of the equal weighted indices, which is encouraging. You do need other parts of the market. You need the cyclical sectors of the market to come in and pick up where tech left off. And I think we all, both bulls and bears, did not expect that the NASDAQ could continue at the clip that it had been going for the whole year. And in particular, those Magnificent Seven names probably couldn't sustain that style of return through the entire year. But then I'll back up too, and a lot of what I do is macro viewpoints and how those affect capital markets. So as far as the economy goes, I am just as surprised as anybody else that things have stayed so durable through 2023. When we came into the year, we were in the midst of the fastest hiking cycle in many, many years, in decades. And I think what most people expected to happen was that it would work. and that the Fed would get what they wanted sooner than what's actually occurred. And what they wanted was to constrict capital, constrict demand in the economy, and slow down inflation. What we got was a slowing of inflation, a cooling of inflation, but really not that much of a slowdown in demand or a slowdown in the labor market yet. So it sort of defied expectations. And one of the things that's really interesting, if you look at a chart of the market right now, which is the lines that we're staring at on this page, is that the market trades more on expectations than it does on events. So if you look at something like the economic surprise indices and look at them for the US versus a bunch of other countries around the globe, the US has positively surprised, relatively speaking, and the rest of the countries, the major countries at least, have either been sort of meh, lackluster, or they've disappointed. So on a relative basis, which is a lot of what investing is, capital has flowed into the US, and it's flowed into, year to date so far, it's flowed into the places that got hit really hard last year. So as much as this strength, I think, has been surprising, I do think it's healthy what's gone on in the last month or so to have a little bit of a cooling off, a give back in some of that multiple expansion, and almost just a check and a gut check on, okay, are the fundamentals really in place for all of these names to drive future returns? And I think the answer to that is yes on some and no on others. And I'm sure we're going to dig deeper on what those specifics are.
Right. So we're looking at a year-to-date chart, and you can sort of see the recent decline, but let's zoom in a little bit and look at the last month of returns. Is the market starting to crack here? So, you can see a reversal in sector movement, clearly energy leading the way while others have been declining over the last 30 days. And you can see, some of the Magnificent Seven names. Obviously, we don't know what's happening with NVIDIA this morning, but you can see, a decline, particularly in Tesla, Meta, and Apple over the last 30 days. So, I'll throw it to you two. Is the market starting to crack here?
I think we're in a seasonally weak period in the markets. August and September are not great months, so there's that. You've had tremendous returns year to date in the Magnificent Seven, and while fundamentals are great, and again, I'll bring up NVIDIA just because the numbers are just staggering, and it's interesting just to see what it is doing today. It is not up 8 or 9 or 10%. It's up about 4%. We'll see where it actually settles out. But that stock was up 229% before the earnings. So I think it's interesting that we've seen all these stocks, the leaders at the first half of the year, start to give back. It's natural, people taking profits. That's number one. Number two, interest rates. The reality is they're going to stay higher for longer. And I think we're going to hear that tomorrow at Jackson Hole from Powell, that the growth in the economy is certainly stronger than they had expected. And inflation has cooled, but it's still elevated. And so as a result, whether they raise in September, November, doesn't really matter. We're probably in the ninth inning in terms of the raising part of the cycle. But I think that they're not going to be so quick to turn and all of a sudden start to lower rates. And so if you think rates are going to be higher for longer, that's going to hurt longer duration assets, growth assets, technology by default. That doesn't mean that you want to sell all your technology and all your growth stocks, but that it does mean it's prudent to broaden out in the portfolio and have kind of a balance between growth and value. And again, talking about the breadth improving, I think that's what investors are saying for themselves. They're taking profits and where they're winners, and they're buying other sectors. And you mentioned energy, but look at the industrials charts. Look at some of the discretionary charts. They're some of them are really encouraging, and we can get into certain specifics if you like. But I think I don't think the market's cracking, Blair, but I do think that it's actually it's balancing out a little bit. And I still think that there are places for both, for tech as well as for some of the cyclical sectors.
Yeah, I would agree. I think the market right now is getting to a more rational place in valuations, particularly in the spots that were overbought and had gotten a little ahead of themselves. A crack in my opinion, wouldn't occur unless there was a real catalyst. And we haven't had one of those. I think there was a chance for NVIDIA to be a catalyst if something had come in terribly disappointing, but that's not really what happened last night. So there hasn't been a catalyst for that. I think there are some things that could happen, and that if they are going to come to fruition, are getting nearer on the horizon, things like a credit crunch, deterioration in credit, or some type of credit event. And again, looking outside the US, there's a lot going on in some of the sovereign debt universes and the currency universe that are concerning and at least worth keeping an eye on. But what I think we can pull out from these two charts, these sector charts, number one, obviously we're seeing the Magnificent Seven give back some of the froth, and I think that's pretty natural. The rotation, the sector rotation that's occurred, and some of the new leadership that's emerged, some of that, I think, number one, is due to the fact that it wasn't overbought. Those cyclical sectors were not overbought. They were more attractively valued, and investors are not terrified. So even if they're rotating around in their portfolio, what it seems like they're doing is just rotating around within the equity market. They're not pulling money out of stocks yet. So there's still not a lot of fear necessarily that we're going to have some broad sweeping sell-off or drawdown or big event. So I think that's part of what the rotation has been due to. A couple of things that I would watch, and I've been more cautious than Steph all year, admittedly, and admittedly wrong about it so far. But a couple of things that I would watch. Number one, the yield curve. I am obsessed with the yield curve, but the inversion that still persists, the depth of the inversion and the length of it does not send great signals for the next 6 to 12 months. And it's not the inversion that's the problem. It's the resteepening that usually inflicts pain on stocks. And now we've resteepened by about 40 basis points from the deepest point. That's something to keep an eye on. And then from a sector perspective, in this last month or so, in the correction, it's interesting that banks have traded so poorly. And the reason it's interesting is, number one, they weren't overvalued before. So it's not just a natural give back in multiple expansion. And if we are worried about a credit event or some sort of credit crunch or deterioration, it would make sense that banks would be the ones that take it on the chin. So I think that there's some concern bubbling under the surface, and that's why banks are trading that way. However, the defensives, the classic defensive sectors like utilities and staples haven't really caught a bid. So again, that tells me that investors aren't really worried about a broad sweeping sell-off, but they are worried about some of the things that naturally happen after a tightening cycle and as the yield curve resteepens.
Right. So
Liz, to your point, sorry, Blair, just on a couple of things that Liz was saying, I think it's interesting to note that there is $5 trillion of cash on the sidelines. And so to the point of a crash in the market, sure, it's possible. Do we have another bank that goes under? Possible. We know their bond books are terrible, right? I do think that the big 6 banks are in very good shape. I don't think we have to worry about the big 20 banks, but it's possible that we could see another issue in that on that front, and that could be the catalyst to have us move lower. By the way, since 2009, we've had 519 bank failures in this country. That really doesn't get talked a lot about. Of course, we have 4,000 banks in the country too. So it's you've got to put everything into perspective, but that could certainly be a catalyst to have something more meaningful in terms of a drawdown in the markets. But again, I look at that $5 trillion of cash in the sidelines, and I think it would be coming in pretty quickly if we do see a pullback, especially if the economy can continue to be above trend. I don't think it's going to be 5.8% GDP this quarter, but I think it could be something like 3%, and that's a heck of a lot better than what anybody thought. Because most people thought that by now we would be in a recession, and we're not. The other thing I would say, I know, Liz watched a lot of items too. I do too. I'm watching jobs. I mean, that to me is the absolute most important thing to watch, because that has propped up the consumer, as I mentioned. That has led to higher than expected wages. Average hourly earnings are running at about 4.4% year over year. That's really very healthy, especially as inflation comes down. So real incomes are actually improving. So again, it goes back to the consumer, and that is the reason why I think jobs are the most important. Because if we have a crack in the consumer, I think that will be a bit more problematic.
Mm-hmm. So I think we've covered pretty well the market trends, particularly on the sector side. Let's just talk for just a moment about value versus growth year to date. For the first time in a long time in 2022, value had its moment to shine, unfortunately, in a down market. We're seeing a reversal year to date, although value and growth, if we can flip forward to that chart, we're in lockstep at the beginning of the year. They've really started to diverge here, with growth leading the way. And particularly, we've even seen, a lot more volume in the IVW versus the IVE. So could you both just share briefly a little bit about your thoughts on growth versus value? And maybe this is just all related to the sector work that we were talking about earlier.
I think a lot of it is sector driven. And I know Steph invests a little bit more on the growth versus value spectrum. So I'll let her dig into those details. But I think a lot of it is sector driven. And the waters are muddied between growth and value today. You've got stocks in the value index that really traditionally would be growth stocks. And I don't know that this is the best way to split it up anymore. But even if you just think about the biggest drivers of what's probably happened this year, I've already mentioned banks, but if you just put all of financials into that camp, that's going to fall mostly in the value index. And obviously, if there's one sector that has seen actual stress this year with what happened in March, it was financials. So the rotation out of that, and then the idea that everything sort of flowed into growth, into discretionary, into tech, and into communications, it just creates that divergence, and that divergence will continue to grow until something changes. And one of the charts that I keep posting, because it's stayed this way, I tweet it all the time, I put it in some of my blogs, is when you look at where real rates are, and then where multiple expansion has gotten to, so where the PE is on the S&P, largely driven by growthy sectors, they've diverged so far, the relationship just isn't working as it normally does. So I think when that relationship comes back into line, meaning either rates come down or PEs come down, then this gap will narrow as well. But it's a difficult thing to sort of quantify the universe into just growth or value, because it puts it in more of a zero-sum game. And I just don't think that's the way that investors can play it this year.
Well, let's talk about some of the things that you ladies have tweeted recently. Stephanie, you recently shared something that not a lot of people are talking about: crude oil. Crude oil is up 24% since June 12th. And you said it's not getting enough attention. Could you talk about that?
Yeah, I don't think it's getting enough attention. I think that no one is paying attention to the supply side of the equation. Everyone's focused on the demand, and they're looking at China, and they're looking at Europe, and how those economies are weaker than expected. But the U.S., obviously, as I mentioned a couple of times now, we're actually stronger than expected. And at the same time, you've had a big change, philosophical and strategic change in the industry over the last several years, where the companies have gotten more religion in terms of production, because we've had these boom and bust cycles for many, many years. That's what this industry is notorious for. But over the last couple of years, the companies are listening to investors, and they would rather, and investors would rather them look at this and use their free cash flow to return it to shareholders in terms of dividends and buybacks. And I have to tell you, last year was really quite something, because I had more companies and stocks that I owned that actually issued special dividends because the free cash flow was pouring in. And by the way, these companies, most of them, make a ton of money, generate a lot of free cash flow, even at $50 oil. So we are comfortably above that. We have been for quite some time. And now these companies are actually doing what we want them to do in terms of not drill, baby, drill. They're keeping production, but they're also increasing CapEx, but they're also being prudent with their free cash flow. And I think that that's something that's very interesting. By the way, we haven't even begun really in earnest to replace the SPR, the Strategic Petroleum Reserve. And that is also going to be a factor, an underlying factor in terms of where oil prices go. So I think that this is a sector that is unloved. It's less than 5% of the S&P 500. Nobody's paying attention to it because you don't have to if you're an S&P 500, if that's your benchmark. But I think that's really where the alpha can be created into the end of this year and into next year. We know that the last 2 years were phenomenal for energy stocks in the sector. At the expense of growth stocks, right? So you had a little mean reversion this year. You had a mean reversion back into growth because growth got crushed last year, and you had a little mean reversion because energy was so strong last year. And now it's still it's down. I'm just looking. It's down. It's about up 1%, but compared to the overall market up 15%, it's lagged considerably. So I think there's a catch-up trade to be had.
Right, and Liz, flipping over to the economy, what about jobs? You had a tweet about average weekly hours falling last week, which is interesting because we're seeing productivity surges this year. How do we look at, how do you approach looking at average weekly hours and what's going on here?
Yeah, this is what makes macro stuff so interesting, is that there's all these different indicators. Obviously, on the surface, the jobs market is still quite strong. We've got more openings than people to fill it. There's plenty of demand. There's been healthy wage growth. There hasn't been a spike in initial or continuing claims, and we're still adding jobs. Those are all very positive things. The reason that we're looking at this and that I tweeted it was because, number one, the average weekly hours, if there's anything that you can look at in the jobs market that is a little bit of a leading indicator, it's something like this. So think about an hourly employee. Before a company is going to lay somebody off, they may just reduce the hours worked. The last thing that a company wants to do is lay people off. So they're going to avoid that at all costs until it absolutely is necessary. So when you see just the trend in this chart, average weekly hours have dropped quite a bit. We're actually now below the pre-pandemic trend. Now, they could go back up. Obviously, none of us know exactly what direction this is going to head in the next 2 to 3 months. But if they continue falling, I would have some concern and probably some serious expectation that we would see a spike in things like initial jobless claims and then subsequently continuing claims. The jobs market is difficult to analyze real time because all of it is backward looking, and a lot of the high frequency data is even backward looking. So by the time it bakes through into things like jobs added and the unemployment rate, it's already well underway. So this is one of those charts that we try to watch as, if we can have a leading indicator, this is something that could serve as that.
I still think it's interesting, though, that you mentioned it. There are 1.6 jobs available still for one unemployed person. So the market is still pretty tight. And I think I look at initial claims, weekly initial claims, on a 4-week moving average, just to smooth it out a little bit. And you're running at about 240,000 on a 4-week moving average basis. A recession and recessionary periods, that number actually on a 4-week moving average basis is 350 to 375. So we're nowhere near the recessionary levels. That's not to say that that chart that you just had up, Liz, and you tweeted it out. That's not a good looking chart if you're a bull on the job market, right? I'm obviously you got to look very carefully and watch and listen to what companies are doing and saying, by the way. And so far, we're not hearing much from the companies. In fact, while supply chains have improved, according to companies on conference calls this past earnings season, the job market does remain pretty tight.
Yeah, and so much conflicting data really since the beginning of COVID. You can make the case either way with a different chart. Stephanie, this is interesting, that something that you tweeted recently, trying to pick stocks, EPS so far so good, but you kind of have to look under the hood. Can you explain what we're looking at here with the micro versus macro?
Yeah, so because we're talking, and you just mentioned there's so many cross currents, and Liz and I are both kind of trying to deal with all of this and come to a conclusion. And it's hard, right? I mean, it's really challenging. This is a tough year. You've got some really powerful, strong trends, which I mentioned earlier in consumer, but you've got really weak trends in manufacturing, and there are a lot of unknowns out there, especially with the Fed. And oh, by the way, we know the Fed works on a lag basis. Have we seen that yet? Right? No, we haven't, probably. So there's a lot of cross currents, and I think the most important thing as a portfolio manager that I do is I just kind of keep my head down. I love to talk macro. I think it's very, very important, but I also like to listen to what companies have to say. And I just mentioned a couple of commentary that companies said during earnings. Supply chains are easing, input costs are coming down, but labor shortages still remain. Overall, the demand has been better than expected. And as I mentioned, earnings are coming in a little bit better than expected, or less bad, right? Because it looks like the last quarter just came in at down 4%. I actually think, just listening to what companies had to say, I was expecting companies to lower guidance going forward, and we didn't get that across the board. So I think maybe you're in a period where you're seeing kind of trough in earnings, and I just listen to what companies and what they have to say, and I've liked what I've heard, at least so far.
So let's flip to the yield curve, because interest rates have been, top of mind this week. We've got the 10-year, breaking out in areas where we'd seen resistance before. Liz, this is from your blog. We're potentially re-steepening the yield curve, or maybe uninverting. Can you talk about the movements we've seen in interest rates recently?
Yes, and anybody who follows me or listens to me is like, when is she going to shut up about the yield? It's been something that I've been watching very, very closely. We had a little bit of a re-steepening earlier this year when the bank stuff happened, and then we kind of reversed course and went back into full inversion. So the re-steepening that's happened recently has been more so what's called a bear steepener. And what that means is that long-term rates have gone up faster than short-term rates. And in reality, what happened was long-term rates moved quite a bit, short-term didn't really do much. The reason for that is something that's going to sound bullish for the economy, but perhaps bearish for stocks. So bullish for the economy because you've got things like that Atlanta GDP tracker coming out and saying over 5% growth. We've got a durable economic data that's come in and inflation data that's gone down. So if that is the only thing that the yield curve is responding to, the 10-year yield rose a bit in the expectation of what Steph mentioned before, rates are going to be higher for longer, but perhaps on the heels of the idea that growth is also going to be okay. So we can sustain higher rates on the longer end. The issue is that the short end didn't really move much. And what would need to happen over time, and I think those in the soft landing camp are hoping that this happens, and the Fed would hope that this happens, this is what would be called threading the needle, is that they can slowly cut rates, slowly bring down the shorter end of the curve, so the 2-year portion of the curve, and return the yield curve to a normal slope. If that happens very gently and very gradually over time, it could work. The issue is that it's just never really worked that way, especially from this deep of an inversion that's been going on for this long. So the reason I'm watching that is because if you look at the timing over history, over longer terms of periods of history, which this chart doesn't show, but if you look at it over a long-term period, the recession shading and the issues in the stock market typically happen as the yield curve reapproaches zero, as the inversion reapproaches zero. So this is something to really keep an eye on. I do expect that this will inflict some pain on stocks. It's just a matter of whether or not it will actually also result in a recession or be coupled with a recession, and how bad that pain might be. So far, it's been pretty orderly. What we don't want to happen is that it becomes disorderly throughout the rest of the year.
I think it's interesting if, in fact, if the yield curve does continue to steepen. I agree definitely in terms of all comments that Liz just said, but one sector that will benefit from a steeper yield curve is financials.
Yeah.
And no one is talking about that. No one even wants to talk about any banks, insurance or any financials whatsoever. And they're quite cheap. I mean, when you can get some of the top rated banks under 1x book value with dividend yields of 3-4%, it's very interesting to me. And again, a steeper yield curve is their friend for sure.
I agree. Let's try to use our last few minutes to talk about our final topic, what might be coming next. Liz, you shared, consumer sentiment. Obviously, everybody was predicting a recession, but we've pretty quickly switched the narrative to expecting a soft landing. How do you look at, these consumer sentiment numbers and the recent surge that we've seen amongst investors?
I think the surge in consumer sentiment and consumer confidence indices is largely due to the combination of market up, inflation down, and consumers are still employed, right? So if you're sitting at home, you've got a job, you feel pretty confident that if you don't have that one, you can find another one. Inflation has come down, so you feel better about the future of what you're going to have to spend. And the stock market is up, so when you look at your balance and your statements, you feel pretty good about that too. So it's easy to see a spike in consumer sentiment on the heels of that. I would be careful, and this is where I'm probably much more cautious on the consumer than Steph is. I would be careful to put too much weight in those consumer confident and sentiment numbers because they can change so quickly. And both of those surveys are taken over a 1-week period each month. It literally could change if you ask the questions 5 days later. So be careful to make too many investment decisions based on that. The other piece of this that I don't think has baked all the way through yet is that inflation is still growing. It may have stopped growing as quickly, but it's still growing. And we haven't necessarily experienced deflation. And the consumers that are getting hit hardest by that, although maybe they don't make up the majority of consumption and they don't make up necessarily all of the stock market, but the consumers that are getting hit hardest by that are adding to their credit card balances, and they are in a much more precarious position. We also have the student loan piece that's coming back online in fall. So I think this is something to watch. And again, to Steph's point earlier, a consumer will keep spending as long as they have a job. As soon as they feel like they don't have a job, that's when the spending comes to a screeching halt. And I think that there is some concern bubbling up in the market as well. Despite these really good sentiment and confidence numbers, retail stocks have not been trading that great either. So there are some investors that I think are concerned the consumer might crack before the end of the year.
That's very interesting. So let's talk briefly about housing. We've talked about interest rates in stocks and sectors, but 30-year mortgage rates, it's over 7%, and yet it seems that housing has completely recovered. How do you make sense of what's going on in the housing market?
There are two parts of this, right? I mean, new home sales are back to levels not seen since March of last year. Yesterday, we got numbers and 31.5% year over year. I mean, that's just a significant number. On the flip side, existing home sales have been the big drag. Why is that? Well, it's kind of obvious. 80% of people that have mortgages under 5%, more like 2 or 3%. And so now you have mortgage rates at 7%. So you're not going to sell your existing home with a 2% mortgage to go buy another home with a 7 handle on it, right? So I understand the existing home sales side of things. On new home sales, we just aren't building enough. We've had 13 years of massive underproduction, and these companies, these home builders, have actually had a lot of discipline. And they've listened to investors as well, just like the energy companies did. So they're not able to build fast enough for demand. But new home sales are very encouraging to me. I think that it has been a surprise at how much we have seen the recovery on the new home sales front. I'd rather, instead of playing it on the home builder side of things, I actually want to own some of the home improvement companies, which have massively lagged the home builders year to date. And all of these companies just reported earnings, and you had some pretty good numbers in terms of profitability. We'll get the demand side eventually in terms of same store sales to recover. But the profitability at some of these home improvement companies it's really amazing and very encouraging. And again, another place I'd like to be investing in.
Well, I know we're over time. Maybe we can just end with the recession probability, right? This was the year that everybody expected. The recession that hasn't happened yet or may not happen. We're starting to see people reverse course and the probability of recession start to tick down. I'd love to hear just 15 seconds from each of you. What do you think? Is it still too early to claim victory, or might we really be headed for a soft landing or no landing?
I still do not think this time is different. I find it hard to believe that we raise rates by 525 basis points and don't have some sort of pain and sort of whistle past it. So my recession probability would still be quite high in the next 12 months. I'd even put it above the 66%. It's just the magnitude that's the question.
What I can say is I do not think with pretty high conviction that we're going to see a recession between now and the end of the year. And that's definitely different than what other people were saying. We don't know the lag impacts from the Fed. And so next year, the probability is certainly higher, but there is so much underlying momentum, even from the recent stimulus that has been put into the economy, which is being an offset to the higher interest rates, meaning all the infrastructure bills that have been put in place. And so I still think you want to be diversified. I don't think you want to have an overweight on growth. I think you want to definitely have a value bias at this point, especially as rates remain higher for longer.
Well, we're over time. I'm sorry we didn't get to the Q&A. There was some great suggestions in there. Maybe we can get this group together again next year to see if that recession actually comes to pass. But I just want to thank Stephanie and Liz for their time. And I want to thank YCharts for putting this on today. And thank you all for attending.